2018 Supreme Court case, South Dakota versus Wayfair, changed really everything about how states can now reach into every single business and demand sales tax, even if the state has no physical presence there. So that was 2018. We're here 7 years later, and most business owners still aren't fully compliant, don't know how this works, and states are getting more aggressive. So just to back up and to tee this up, really the law heading into 2018, dating back to the really reaffirmed in the Quill versus North Dakota tax court, was that if there wasn't a physical presence in that state, you couldn't acquire or get sales taxes essentially. But then the Supreme Court ruled 5-4 in favor of in favor of South Dakota versus Wayfair, which now opened the door where states could impose sales tax collection based purely on economic activity. And so South Dakota was the first one to set this law that said, if you're an out-of-state seller and you do over $100,000 in sales or 200 transactions in that state, you now must withhold sales taxes to anything sold in the state of South Dakota. Of course, what happens then, every single state looks at this as a money grab. So then all of them say, oh, we're on board with this too. And now here we are 7 years later, there's 50 different states and there's practically 50 different sets of rules. So it's a big compliance nightmare for business owners selling any type of product.
Yeah, it's been, to say it's a pain is an understatement. And really, with all the e-commerce that goes on, this is just a nightmare. And you're right. A lot of entrepreneurs don't even know. You and I have met entrepreneurs that do business in multiple states and they're like, what? I've never heard of that. That's a problem.
Yep. So most states now are at a $100,000 sales threshold. And that means that if you do over $100,000 of sales, you now are required to really withhold and remit sales taxes into that state. California and Texas have a $500,000 sales threshold. New York, $500,000 in sales and 100 separate transactions. And so then there's different ways of how you measure this. Is it based off of a calendar year? Is it trailing 12 months? And when you look at the different state and local tax jurisdictions, there are over 12,000 different state and city sales tax jurisdictions. So it's very, very hard to be completely compliant because of all the complexity here. And then we're going to show a chart here that shows the 31 states with that tax internet sellers without physical presence. So there's going to be, this is just something that the tax foundation put together here. So one thing that I think is also overlooked, that we're talking sales tax, is that there's also income tax nexus that can be derived too. And this is another thing that a lot of entrepreneurs are also not compliant with, which is, okay, maybe I'm not selling into that different state, but oftentimes if you have a certain amount of sales thresholds, usually $500,000 or more, $50,000 or more of property, or $50,000 in payroll, you oftentimes need to then pay state income taxes in that state. And so if you're a pass-through business, which most of our clients are, with S corps or partnerships, the business, you file all of that profit flows through to your 1040, and then you need to file an state income tax return in all of these different states. So a rough rule of thumb that we like to say is, if you have an employee, you have income tax nexus. So now you're at a stage where sales tax nexus, income tax nexus just makes this so hard to be compliant with across the board.
Super complicated, and that's why a lot of people use payroll services when they have employees in different states. They use different programs and companies to try to keep this straight, but it is a nightmare. I remember one time California came after me years ago saying that I owed California taxes, and we've never had an employee in California. We have a rule that we don't hire in California because it's very anti-employers in California. And yet my accountant sent a letter telling them to pound sand and they went away. But they were trying to come after me for California income taxes. And I've never lived in California. I've always lived in Arizona. It's just a bizarre thing, but it's frustrating to entrepreneurs.
Yeah. And as you mentioned, so software is now caught up to the place where, I remember in 2018 when that case went down, really, and then COVID really just skyrocketed online sales, obviously. But now with TaxJar and Avalara are the two biggest best-in-class solutions. And now they have pure API integrations that can be built into your Shopify account. Amazon now has it built onto the FBA system. So there's a lot of software that's been built up around this. You can kind of outsource it where they'll automatically withhold the sales taxes and remit it for you, akin to what a payroll provider like an ADP or a JustWorks or a Gusto will do on the payroll side. So those are the two big ones that will track sales against every state's economic nexus rules. They'll integrate with your e-commerce platforms, as I mentioned, and then really automate the filing. So that's helped from a compliance perspective. But one thing that I think that we're starting to see more of, I shouldn't say think, that I know we're starting to see more of is states coming after their cut. And so California is known to be very aggressive. Their Department of Tax and Fee Administration has really gone after Amazon, because what they would do is they subpoenaed Amazon, and if Amazon stored any of your warehouse in California, you now potentially trigger nexus. So even if you're not hitting the sales thresholds in California, your physical property, if over a certain amount of money, is sitting in California because Amazon put it there, not because you put it there, you now have a California income tax liability.
Wow. Leave it to California.
They need to make some money, I guess, right? And then the big thing, right, if you're California, really what they're looking to go at too is not just income and sales tax, but then foreign filing fees, because then you need to register to do business in California as a foreign filed LLC. That's an $800 a year renewal that's going through the California Franchise Tax Board,
and it goes up too based on revenue.
Yeah, right, exactly.
It's not based on profit.
Yep.
You could make no profit and you'd still owe that foreign LLC tax to the government.
Yep.
Bizarre.
And so when I was looking at the tax foundation, sales taxes, which were really small, now account for about 30% of all state tax revenue.
Wow.
Second only to individual income taxes, which is at 38%. So it is a huge driver of this. And it's bigger for obviously states that don't have income taxes. So Texas derives 74% of its tax revenue from sales taxes. Obviously Texas has high property taxes too, which makes up the bulk of the rest of that. South Dakota, again, tax-free state, is at 65%. Tennessee over 60%. So these states need that sales tax revenue, hence why the enforcement is very aggressive now.
Yeah. What are you going to do? New taxes all the time.
Taxes. So a lot of issues here with entrepreneurs. That's one good thing about providing a service, is that we don't have to deal with all of those sales taxes and those nexus requirements.
That is true.
Otherwise, it gets
and we don't have to deal with
complicated.
inventory and some of the other things that are challenging to a business.
Yep. But it is also very hard to scale a service-based business because you scale off of people, which everyone knows people are not the most scalable.
You're very right on that. We've figured that out.
All right, let's talk through a last angle here of sales tax and why is tax compliance important. This is a huge M&A due diligence item. And so sales tax is one of the most frequent sources of material exposure uncovered during due diligence. And I know, talking to entrepreneurs all day, every day, a lot of entrepreneurs are not fully compliant. If you were to say that starting going back to that 2018 date when the Wayfair lost to South Dakota, oftentimes what happens is that an entrepreneur kind of decides at a certain point they want to start becoming compliant, and they'll start remitting sales taxes once they get the system and the platform set up. But then the risk and kind of the game theory is, well, is the state now going to say, well, where's my money from all these previous years? And are they going to start sending letters, send an audit, and go after you? And right, if you haven't filed the returns, then there is no statute of limitations. So when you're looking at M&A deals, there's going to be reps and warranties that are going to be specifically baked in here, and some liability, because if the states come after this entity after you sell it, then obviously the new buyer is going to say, hey, this was your problem. You're on the hook for that.
Yeah. I think the lesson there is, when you're running a business, you want to run it as clean as possible, because you think like, oh, well, I don't have to pay that. I don't have to worry about that. I don't have to have my P&L lined up, my books and records, all that stuff. If you ever sell your company, all that stuff can come back to bite you. And definitely, as you said, from an M&A angle, if your buyer sees a skeleton in the closet that could come out to get them, even if it's a low risk, they're going to hit you on the price over that, because they're going to say, hey, this could happen because you didn't do what you should have done, years ago.